If you took $100,000 right now and invested it, how much do you think you'd have in 10, 20, or 30 years? Most people guess a number that feels reasonable, maybe double, maybe triple. But the real outcome depends entirely on where that money is invested. And that one simple decision can be the difference between ending up with $4 million or $17 million. In this video, I'm going to compare VOO, SPY, and QQQ across their structure, sectors, past performance, dividend growth, volatility, liquidity, and long-term wealth projections. And in the end, I'll show you and John which one of the three can turn a single $100,000 investment into a portfolio worth over $17 million. But before we compare anything, it helps to understand the basics of what these funds actually are and why they behave so differently from each other. When people start thinking about investing, they usually want something simple, something they can trust without turning their life into a full-time market project. Saving alone doesn't feel like enough anymore. Prices rise, goals get more expensive, and keeping cash in a bank can feel like you're slowly falling behind. So most people look for a reliable place to grow their money, and that search almost always leads to three familiar names: VOO, SPY, and QQQ. VOO is a low-cost S&P 500 ETF launched in 2010. It charges a 0.03% expense ratio and manages over $1.4 trillion in assets. Its appeal comes from broad diversification and extremely low fees. SPY tracks the same index but has been around much longer. It launched in 1993 as the first U.S. ETF ever created. With a 0.09% expense ratio and high trading volume, it's known for being easy to buy and sell at any moment. QQQ is different. It tracks the NASDAQ 100, which is much more concentrated in technology and growth-oriented companies. It launched in 1999, charges a 0.2% expense ratio, and manages over $400 billion. Because it focuses heavily on tech, it tends to be a more volatile mover, both up and down, than broad market ETFs like VOO and SPY. VOO and SPY follow nearly the same pattern because they track the same index. QQQ follows a different path because it's built around a different part of the market. And once you see how each one is structured on the inside, the differences start becoming much clearer. When you look inside VOO, SPY, and QQQ, the differences become easy to see. VOO and SPY both track the S&P 500, so their layouts are nearly identical. Technology makes up roughly 36% of each fund, making it the largest sector, but the real strength of these two ETFs is their balance. Financials sit near 13%, healthcare around 9%, and consumer cyclical and communication each hover near 10%. No single sector overwhelms the others, which is why these funds tend to move in a steady, predictable way. Their holdings follow the same pattern. The top names, NVIDIA, Microsoft, Apple, Amazon, Meta, Alphabet, Broadcom, and Tesla, collectively make up just under 39 to 40% of each ETF. The remaining 61% is spread across hundreds of companies, which keeps risk manageable. VOO holds 507 stocks, SPY holds 504, and in day-to-day behavior, they're almost interchangeable. QQQ takes a different approach. It tracks the NASDAQ 100, which is far more concentrated in technology and growth-focused companies. Tech alone accounts for more than 55% of the fund, with communication and consumer cyclical names making up much of the rest. Its top 10 holdings represent more than 53% of the entire ETF. NVIDIA, Apple, Microsoft, Amazon, Broadcom, Alphabet, Meta, Tesla, and Netflix dominate the lineup with a higher percentage allocation, and because they move quickly, they pull the fund with them. This level of concentration gives QQQ stronger swings in both directions. When the tech sector leads, QQQ tends to outperform broad market funds like VOO and SPY. When tech slows down, QQQ reacts more sharply because it doesn't have the same diversification buffer. So holdings explain how an ETF is built, but performance shows what that structure actually produces over time. So let's look at the numbers. This is where the differences start to show. VOO and SPY look almost identical on paper, and their performance reflects that. Over the past year, both have moved nearly the same way, returning around 14%. QQQ, on the other hand, pulled ahead with a gain of about 21%, largely because it leans more heavily into faster-moving technology companies. When you expand the view to 3 years, the gap widens. VOO and SPY sit close to 73%, while QQQ reaches around 118%. Looking at 5 years, VOO and SPY come in at nearly 93%, showing steady growth through diversification. QQQ ends closer to 115%, continuing its pattern of outperforming during periods when the tech sector leads the market. Cloud computing, digital platforms, and AI-focused companies have driven a large part of that strength. The 10-year chart makes the difference even clearer. VOO and SPY each return about 226%. QQQ comes in at roughly 443%, almost double. However, the charts also show a truth every investor needs to remember, that higher return comes with more movement. QQQ's path includes sharper drops and faster rebounds. VOO and SPY rise more smoothly, which is why many investors find them easier to hold during uncertain periods. In a couple of minutes, I'll show you and John what that means in terms of dollar returns, and which one of the three can turn a single $100,000 investment into a portfolio worth over $17 million. But before we get there, let's take a look at the dividend side of these ETFs. Dividends and technical trends offer a more complete view of how VOO, SPY, and QQQ behave over time. VOO has a dividend yield of about 1.12%. It may look modest, but the key is consistency. Its dividend growth rate sits around 6.17% per year, which adds meaningful progress when reinvested. SPY is slightly lower at 1.06%, but it has one of the longest and most reliable dividend histories in the ETF world. Both funds focus on stable, predictable income rather than high payouts. QQQ is different. Its yield sits near 0.45% because most of the companies inside it reinvest their profits instead of distributing them. That's why QQQ's dividend income is small, but its long-term growth can be significantly larger. Its performance is driven by price appreciation, not yield, so it's not for dividend investors. On the technical side, the trend lines tell the same story. VOO and SPY sit comfortably above all their major moving averages, the 10-day, 50-day, 100-day, and especially the 200-day, showing a smooth, steady uptrend. Their price action feels stable, controlled, and in sync with the broader market. QQQ sits even higher above its long-term averages. Its distance from the 200-day moving average, more than 15%, shows just how strong its momentum has been. But that distance also highlights its sensitivity. When markets are rising, QQQ tends to sprint, but when markets hesitate, it can pull back faster than diversified funds like VOO and SPY. And that brings us to the risk side of these ETFs. Risk is where the differences between VOO, SPY, and QQQ become more noticeable. Even though all three are popular and widely trusted, they do not expose investors to the same emotional experience. VOO and SPY both sit close to a beta of 1, which means they move almost perfectly in line with the overall market. Their diversification across roughly 500 companies keeps their volatility controlled. When the market drops, they drop with it, but usually in a measured way. When the market rises, they follow that upward trend with steady momentum. This is why many investors find them straightforward to hold through different environments. QQQ, by contrast, carries a beta of about 1.26, and that difference shows up quickly. A 1% move in the market often translates into about a 1.3% move in QQQ. Because more than half of the fund is concentrated in high-growth tech names, it tends to react faster, both on the upside and the downside. During tech-driven rallies, it can outperform by a wide margin, and during corrections, it can pull back more sharply. Liquidity adds another dimension to risk. SPY trades an incredible $50 billion per day, making it one of the most liquid financial assets in the world. QQQ follows with around $33 billion per day, also extremely liquid. VOO is still very strong but much lower, at roughly $5 billion per day. Higher liquidity generally means tighter bid-ask spreads and easier order execution, especially during volatile periods. SPY and QQQ maintain that flexibility even when markets move quickly, while VOO can occasionally see slightly wider spreads simply because it trades less frequently. With the structure, performance, dividends, and risk picture now clear, let's see what all this actually means when you project a one-time $100,000 investment over 10, 20, and 30 years from now. Starting with SPY, the fund comes with a 1.06% yield, a dividend growth rate of 5.8%, and a 10-year average price appreciation of about 12.8% per year. Based on these metrics, after 1 year, the portfolio is projected to be valued at $113,860. By year 10, it's expected to reach $357,329 and pay around $1,739 in annual dividends. At year 20, the value is projected to rise to $1,232,236 with nearly $2,910 in yearly income. And at year 30, SPY is projected to land at $4,176,629, generating about $4,779 per year, or roughly $398 per month. Of that growth, $4,805 comes from appreciation and $75,824 from reinvested dividends. Moving to VOO, the fund carries a 1.12% yield, a 6.17% dividend growth rate, and a long-term average price appreciation of about 12.83%. After the first year, a $100,000 investment in this portfolio is projected to reach $113,950. At year 10, it's projected to grow to $360,047. At year 20, the portfolio is expected to reach $1,249,558 with dividends of $3,339. By year 30, VOO is projected to end at $4,257,134, generating $5,719 per year, or about $477 each month. Breaking it down, $4,070,389 comes from appreciation and $86,745 comes from reinvested dividends, totaling $4,157,134 in added value. Finally, QQQ. It has a 0.45% yield, strong dividend growth of 9.45%, and long-term price appreciation of about 18.66% per year. Given these metrics, after 1 year, the portfolio is projected to climb to $119,110. By year 10, it's projected to reach $567,683. At year 20, it's expected to be valued at around $3,172,217, but the 30-year result truly stands out. QQQ is projected to grow to $17,620,167. Almost all of that growth comes from appreciation, $17,470,020. So who wins with $100,000? VOO and SPY both track the S&P 500, so their long-term paths stay very close. But when you look at the projections, VOO still edges out SPY by a small margin. SPY is projected to reach about $4.17 million, while VOO is projected to end near $4.25 million, adding roughly an extra $80,000 over 30 years. But QQQ is in a different category. Its higher growth rate pushes the production to around $17.6 million, which isn't just ahead of VOO and SPY individually, it's more than both of them combined. Not everyone can start with $100,000, and that's completely normal. If you're building from a smaller amount, click the video on your screen to find how a simple $5 a day investment can grow into a portfolio that pays more than $8,000 a month in dividend income.